Hey friends, welcome back to another episode of Making Sense of Your Market. Today is Saturday, it's February 19th, 2022. I wish there was a button I could push that goes alert, 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 or something I can put over the screen. I need you to listen. This is the most important message I will make this year. It's so important relative to what's going on with the Fed funds rate. You've probably seen in the news, or you will see in the news, information about the Federal Reserve raising the Fed funds rate in March and therefore also in July or after. They've already projected a massive rate hike in 2022, but the news that you need to pay attention to is in March, the Fed funds rate is going to get lifted or raised 50 basis points. That's a half of a point. I learned a long time ago from Jim Rohn. He is one of the best self-improvement, personal development gurus out there. He talked about seasons. Well, Tony Robbins is today's self-help, personal development guru. He talks about cycles. He got this from Jim Rohn. Tony Robbins said recently, if he could give one piece of advice to Americans, young adults today, he would say, learn to understand and interpret cycles. We are in a cycle right now. That's all it is. It's an ugly cycle. In the next 6 to 12 months, it could get pretty ugly economically speaking. And I want to explain this, not scare you. So going back to the Fed and cycles, the Fed has not raised the Fed funds rate 50 basis points in one meeting since 2000. That was 21 years ago. That's profound. You need to pay attention to this. More so, on top of that, they've recently come out and predicted and said that by July, not by December, but halfway through this year, the Fed will have raised the Fed funds rate 1 full point. So the next video that I'm going to do is talking about what happens to the economy, what happens to housing when the Fed raises the Fed funds rate aggressively like this. What I can tell you is that they raise the Fed funds rate and lower the Fed funds rate based off of economic conditions. When the economy is screaming, they raise the Fed funds rate to slow it down a little. When the economy is struggling, like during COVID or during 2008, 9, and 10, they lower the Fed funds rate to make money less expensive. Right now, we're seeing inflation through the roof. We're seeing the cost of everything, gas, oil, water, sewer, garbage, utilities. You go to the grocery store, everything is 7 to 10 to 15% more expensive than it was last year. So they're using the Fed funds rate to combat that. I don't believe, and neither do a lot of economists believe, that that is the solution. I think it's going to drive our economy right down into the tanks. What you need to know about this is to save. Having a budget is more important than ever. Let me say that again. Having a budget, monitoring your personal family budget every single month, knowing what's coming in, knowing what's going out, and knowing what's left over is more important than ever. You can go to budgetwithdan.com. I've made that page for the sole purpose of educating young people, my clients, and anyone in general on how to budget better, how to do it, and the importance of it. Having a budget changed my life financially forever. I've subscribed to this for the last 12 years, and I can tell you that if you pay attention to your money, great things happen, and you can do more with your money. Now more than ever, because of the economy that we're in, I want to encourage you, stack money away. Find ways where you can save more money. Stop spending like we have over the last few years. Tighten things up through this season. And when we get through this season, there will be a great harvest in the next season. That's the whole idea of understanding seasons and cycles. But we're in a crazy one right now. We're probably in the fall of a pretty tough winter coming ahead financially in the U.S. Pay attention to my warning, and you'll come out of this in 2023 better. I'm not here to scare you. I'm here to teach you and to impress upon you that if you pay attention to this stuff right now with budget, you'll be okay. If you don't, it's going to be tough. I think that what's going on in the economy is going to destroy the middle class and upper middle class because they're fixed income. Most of the middle class and upper middle class has fixed income every single month. Two people working, they bring in $8,000 a month, they spend 6 or 7, and if you take inflation and the cost of goods and the cost of rates going up, you're going to eat away of what's left over. Pay attention to your budget right now. I want to close with this. Week over week, interest rates are up. a little. We're at 3.99. Let's just say 3.875 to 4.125. Still a great time to finance real estate. The housing market's on fire. Pay attention to that as well. Housing's great. Housing's connected to jobs, so I'm not saying the housing market's going to tank. Still a great time to be a part of history and buy real estate right now. If you have any questions, reach out to me on that. I do mortgages for a living. That's what I love. That's what I do. But I'm very passionate about teaching people about how to better manage their money, not necessarily invest. I refer that over to financial planners. All right, let's close with this. How to make a win-win agreement. This is week 32 of our 52-week series from Dr. Stephen R. Covey. Every single week I talk about mortgage, I talk about money, and I talk about mindset. Here's our mindset piece. How to make a win-win agreement with someone. The importance of a win-win. I'll tell you the key. It's listening. Listen, let it digest before you speak or give feedback. That's the key. So many people want to push their agenda before they listen to the other person. So I want to encourage you, like I am as a father right now, and as a husband, and as a businessman with my clients, I'm trying to listen better. I hope this information was helpful. Share this. People need to know more about this. Down below this video, you'll see the articles from CNBC and from the Citigroup. I hope this helps you. I'll see you next week. Bye for now.